students, very good morning and a warm welcome to Dr. Academy for Taxation and Accounting. Through this video, let us discuss the important rules regarding computation of profits and gains of business or profession. First important point or the rule regarding the computation of income from business or profession is the business or profession should be carried on by the assessee. The tax is chargeable from the person who carries on the business or profession. The essential requirement is that he should be entitled to carry on the business. It is immaterial if the assessee, who is the owner of the business, carries on the business through a manager or through a servant or through any other person duly assigned for him. Guardians for minor or receivers or trustees are assessed under this section in respect of the profits of business carried on by them. So the point here is the business or profession should be carried on by the assessee, and it need not be the assessee he himself doing it, but he could done or get it done through other person also would be accessible to the assessee under the broad title income from business or profession. Second point is the profits and gains of different business or professions carried on by an assessee are not taxable separately, which means it has to be taxed under one head on the aggregate income of all the business or profession carried on by an assessee. The essence of this rule is that if in a year he earns profit in one business and sustains loss in the other, he can set off his loss of one business against the profit of the other, and the balance amount shall be the income taxable for that assessee. The point here is the assessee may be having different business. The aggregate of income of all the business would be taxable. The next point is profits and loss of speculation business carried on by an assessee are to be kept separate. So speculative transactions are transactions in which a contract for the purchase or sale of any commodity, including stocks and shares, is selected otherwise than by actual delivery or transfer of the commodity or receipt. Therefore, we can say that speculative transactions are not real transaction, but it is agreement to buy or sell or agreed to buy or sell. Any income or loss arising out of speculative transaction has to be kept separate. Income or loss from a speculative transaction cannot be adjusted with a genuine business transaction. It has to be kept separately. The assessee should have carried on business or profession for any time during the previous year would be eligible for computation of profits and gains of business or profession. Profit made on winding up of a business by the sale of assets in one lot are not taxable as business profit but as capital gain. If these assets include stock in trade, which is also sold out, and its sale consideration can be separately determined, the profit on the sale of the stock in trade will be taxable as business profit because the sale of goods under any circumstances is a transaction in the nature of trade, and hence it is profit taxable as business profit. The next point is the legal ownership only will be considered. The point here is if the promoters of a company acquire a business to be passed on to the company after its incorporation, and in the meantime they carry on business and earn profit during the previous year prior to the incorporation, such profits are not accessible in the hands of the company because the company does not exist before its incorporation. However, the tax is leviable on the person to whom the profits accrue or arise, or by whom the profits are received. So these profit arised before the date of incorporation cannot be taxed from the hands of the company, but it could be taxed from the hands of the promoter who is in receipt of the income. No tax can be levied on a binamidar in whose name the business transactions are effected and who is not really entitled for that profit. So therefore, the person who is the real owner of that entity during that time, or I would say during the previous year, shall be liable to tax. No tax is payable on anticipated profit or notional profit. The tax is levied on the actual profit of the previous year and not on the anticipated profit. Notional profits are those profits which are not actually earned from an outsider. For example, sale of an asset by the business to its proprietor at a higher price results only in book profit, as it is not actually earned from an outsider. Such a book profit is notional profit and it is not taxable because it is not real one. An isolated transaction of purchase and sale is in the nature of trade. Expenses incurred in connection with earning such income shall be deductible and it could be adjusted while computing the profits and gains of business or profession. Tax payable on the income of every business or profession, whether it is legal or illegal. The income tax law is not concerned with the legality of the business or the profession. The expenses incurred to earn income from illegal business which are incidental to such business are to be allowed as deduction out of the income earned from that illegal business. However, penalties levied for infraction of law and expenses incurred in defense of criminal proceedings are not to be allowed. Laws computed under illegal business cannot be set off against any profit from a legal business. If loss sustained from an illegal business can be adjusted only against another income from another illegal business. Expenses incurred before setting up of the business. These expenses are not admissible. In the case of a company, expenses incurred before incorporation are not allowable. But those incurred after incorporation but before the commencement of the business are allowable. However, specified preliminary expenses incurred by an Indian company or any other resident person is allowed under section 35D. The next point is that if the benefit of an expenditure incurred in an accounting year extends beyond the accounting year, it is to be wholly allowed in the year in which it is incurred and it will not be spread over full benefit period. For example, heavy expenditure on repairs done in 1 year resulting in no requirement for repairs for the next 2 or 3 years will be allowed in the year in which expenditure is incurred. So here the point is the expenditure has to be absorbed in the year in which it is incurred. It is essential to keep in view the general commercial principles while determining the real profits of the business. Sometimes there are some such expenses or losses which are not expressly allowed under the Income Tax Act, but which must be deducted according to the general commercial principles in order to arrive at the real business profit, and hence they will be allowed as deduction. Therefore, every income tax authority must possess full knowledge of the general commercial principles. Business laws which are not of a capital nature and which have been sustained during the previous year and which are incidental to the business carried on by the assessee are deductible while computing the income under the head profits and gains of business or profession. The next point is if an assessee receives during the previous year any sum connected with the business which during any preceding year was allowed as deduction, then while computing the taxable profit of the year, it will be taxable as a business income during the previous year in which they are recovered. Any dharmada collected from customers is not a trading receipt and hence not liable to tax. Underwriting commission earned by the assessee on the shares subscribed by the public is assessable as business income, whereas the underwriting commission on shares subscribed by the writer himself reduces the cost of shares and is not taxable. And finally, taxability of awards for sportsmen. If a person who is a professional sportsman receives some award, it is treated as his professional income and hence he is liable to pay tax for that. The next point is computation of profits and gains of business or profession. Section 30 to 43D is dealing with the computation of profits and gains of business or profession, in which section 30 to 37 are deductions expressly allowed. Section 40 is dealing with the disallowed items. There are few more deductions are allowed on the basis of the general commercial principles. Profit should be computed according to the method of accounting regularly employed by the assessee, provided that actual profits can be ascertained by this method. Only those expenses and losses are allowed as deductions which are incurred or sustained during the relevant previous year. Expenses and losses should be incidental to the operations of the business. Only the expenses incurred in connection with the business of the assessee are allowed as deductions. If a business has discontinued before the commencement of the previous year, its expenses cannot be allowed as deduction against the income of any other business of the assessee. There are some essential expenses, though neither expressly allowed nor disallowed, but are deductible while computing the profits of business or profession on the basis of the general commercial principles, provided these are not expenses or losses of a capital nature or in the nature of a personnel. The next principle is any expenditure incurred in consideration of commercial expediency is allowed as deduction. Deductions can be made from the income of that business only for which the expenses are incurred. The expenses of one business cannot be charged against the income of any other business. So while we doing the practical problem, the assessee may furnish the books of account prepared by him and he may furnish the profit. So how we can adjust the profit or loss given by the assessee for the computation of taxable business or professional income. In this context, we can say that the profit or losses arrived by the assessee may be correct or not, because of the reason that several such expenses are charged to the profit and loss account which are wholly or partially inadmissible as per the Income Tax Act. So he might have taken some items which are disallowed items. So we have to see that. Some admissible expenses might have omitted by the assessee while computing the business income. That has to be considered. Some taxable income may not be added to the P&L account credit side. So it to be considered. Similarly, some of such incomes are credited which are either not taxable as profits and gains of business or profession or not at all taxable. So it to be removed from that income. So after considering all these items, we can come up with a format for the computation of taxable income from business or profession So let us start with the profit given by the assessee in the P&L account. And we have certain items to be added and we have certain items to be deducted too. So let us see what all the items to be added back while computing the taxable business income based on the profit given by the assessee. So the first item to be added is expenses or losses disallowed but charged in the debit side of the P&L account. So it to be added. Similarly, income taxable as business income but not credited to profit and loss account. Some incomes are business income, but it is not at all taken into the credit side of the P&L account to be added along with the given profit or loss. The next is expenses entered in excess of which is allowed. Overcharging of expenses to be adjusted. Then undervaluation of closing stock and overvaluation of opening stock. If you undervalue the closing stock, similarly, if you overvalue the opening stock, under both scenario, the gross profit will be reduced. So to that extent, whatever amount it is, the closing stock undervalued or the opening stock overvalued, to that extent, the profit has to be adjusted. So these are the major things to be added with the given profit by the assessee. And the following are the items to be deducted from the given profit while computing the taxable business income. First point is expenses or losses allowed but not debited to P&L account. See, there are certain expenses permitted but not entered in the P&L account. It has to be income not taxable as business income but credited to P&L account. Income exempted from tax but credited to profit and loss account has to be deducted. Similarly, overvaluation of closing stock and undervaluation of opening stock also to be deducted from the given profit. So if you exercise and rework on the given profit with all these items according to section 30 to 43D, you will be arriving taxable income from business or profession. So let us discuss each one of these items, the expenses allowed, disallowed, permitted item, exempted item, all that we will deal keeping the provision in mind in detail in the upcoming videos. Hope this video is going to be useful. If it is, please forward it to your friends and other students. Thank you very much for watching my channel.